Okay, time for chapter 4. Instead of using the PowerPoint slides, I'm going to step you through the three major financial statements. All these numbers are the same numbers that appear in your textbook for chapter 4. So here we have the income statement, and we have the record of revenues and expenses for the year 2012. So an important thing to remember is that the income statement describes various accounting variables as measured over a period of time. So this is for the year 2012. Here we have our net sales of $15 million. Next we subtract the $5 million cost of goods sold. That would be the cost of your materials, labor, and overhead that can be specifically allocated to the goods that were sold. That leaves us with our gross profit. Next we subtract our depreciation expense. This is the amount of additional depreciation taken in the year 2012 for the assets that are on depreciation schedules. So depreciation is an allocation of a cost over time. So the cost is allocated over multiple years. We have $2 million allocated to the year 2012. Next, we subtract selling and administrative expenses. These are expenses that cannot be specifically allocated to the goods that were sold. An example of this might be what it costs for your human resources department. That leaves us with operating income, also known as earnings before interest and taxes, or EBIT. And now we're ready to start subtracting our financial expenses. Here we have $1,710,000 worth of interest expense. I call your attention to the fact that the principal on our debt is down here on the balance sheet. The interest is here on the income statement. That leaves us with income before taxes. You'll note that everything that was subtracted earlier on the income statement was a tax-deductible expense. I subtract the taxes. In this case, we assume 42% is the tax rate, and that leaves us with $3,184,000 of net income. This belongs to the stockholders, the owners of the firm. And there are two things that can happen with this. You can pay some or all of this out as a dividend to your common stockholders. In this case, we have $400,000 being paid to the common stockholders. And so if $400,000 of the $3,184,000 is paid as a dividend, then the rest is by definition reinvested back into the firm. So you'll notice that up here the depreciation expense number of $2 million is in blue, and here the $2,784,000 is in green. And the reason for that is that these are two numbers that reach out and touch the balance sheet. So there's a connection, a bridge, if you will, between these numbers and the balance sheet. So we prepared the 2012 income statement first, and now that that's completed, we're ready to do the end of 2012 balance sheet. So you will notice that we have two columns here. The December 31st, 2011 balance sheet was prepared a year ago. So this column has all the numbers as they were defined at the point in time, which is 5 o'clock, December 31st, 2011. Now the year 2012 has come and gone. We've prepared the income statement, and now we are ready to prepare the 5 o'clock, December 31st, 2012 balance sheet. So we have our cash, our accounts receivable, our inventory, our marketable securities, our prepaid expenses. These are all current assets or short-term assets, if you will. They either are cash or expected to convert into cash within a short period of time, usually defined as a year. Next, we have our longer-term assets. These are our fixed assets. Here you can see fixed assets went up from 14 million to 28 million from the end of 2011, which would be the beginning of 2012, to the end of 2012. Here's our accumulated depreciation. Again, note the blue. So there's a connection here. This line is called accumulated depreciation. It has the word depreciation in it. So it's clearly related to depreciation expense on the income statement, but it's not exactly the same thing. So through the end of 2011, we had accumulated $6 million worth of depreciation throughout the history of the firm for assets that were still being carried on the company's books. These assets right here. If we had some assets that were bought in 1995 and sold in 2003, those assets would no longer be carried on the books, and the depreciation allocated to those assets would not be here either. So here we have the end of 2012 gross fixed assets, and if we had $6 million of accumulated depreciation, and we add an additional $2 million to that figure, we get $8 million as the new accumulated depreciation figure. So that leaves us with net fixed assets of 20 million, total assets of 50 million. So where did the funds come from to finance those $50 million in assets? Well, some came from accounts payable, credit extended by our suppliers. Some came from notes payable. That would be a promissory note that we signed when we took out a bank loan. Some would be from accrued expenses. This would include items such as accrued wages and accrued taxes. So if you are working on the job and you get paid every 2 weeks, and you are in the middle of week number 2 with payday a few days away, your company owes you a salary that it hasn't paid yet. It'll pay it in a few days. So that would be a liability at that point in time on the company's books. So there's your total current liabilities. Those are your liabilities coming due soon, again usually defined as within the next year or so. Next we get our longer term liabilities. Long-term debt. You add your long-term liabilities to your current liabilities, you get your total liabilities. This company has some preferred stock. There's the $1 million for that. The company has some common stock. There's the number for that. And there's a number here, $12 million for what's called capital in excess of par. So what happens is when a company sells stock, it has a certain par value or stated value, and the par value times the number of shares sold to the public gives you the common stock number, and then the amount by which the market price exceeds that par value times the number of shares that were issued is your capital in excess of par number. Might be easier to go back here and look at this. So if this company had issued 1 million shares and the par was $1, you'd have a $1 million amount in the common stock number. And if the price at which the stock was sold in the primary market was $11, then 11 is 10 in excess of 1. So the full $11 million is allocated here, 1 million on this line, common stock, 10 million on this line, capital in excess of par. Then we've got retained earnings. So the company had reinvested $7,216,000 back into the firm through the end of 2011, and now that number has jumped to $10 million. Where did that number come from? Well, we took the $7,216,000 and we added this $2,784,000 change in retained earnings in order to get the new $10 million worth of retained earnings. So this is part of the common stockholder equity of the firm. There's your total common equity. There's your total equity that includes preferred stock. There's your 50 million liabilities plus equity, which equals our total assets. So that's a good thing. The balance sheet balances. Now we have the statement of cash flows. You'll notice that our cash went from $9 million at the end of 2011 to $10 million at the end of 2012. And so that's a $1 million positive change. But there's a lot of stuff behind that $1 million change number. We had $3,184,000 coming into the firm in net income. We're going to add back the depreciation expense that was subtracted out earlier. Why did we do that? Because this subtraction of $2 million on the income statement is the subtraction of a non-cash expense. And so if you want to know how much cash was generated, you have to add back the $2 million to the $3,184,000. Here we had a decrease in cash in the amount of $300,000, and so that's being attributed to the change in accounts receivable. So what happened to accounts receivable? Accounts receivable went up from $700,000 to $1 million. That's a $300,000 positive change in accounts receivable. What happens to your cash when you increase your assets? If you buy a new bicycle, you have a bicycle, but what happens to your cash? The answer is it went down. Here we have a $7,300,000 increase in cash attributed to inventory. What happened to inventory? Inventory went from $17,300,000 down to $10 million. That's a $7,300,000 decrease in inventory. When you have a garage sale and sell some of your stuff, what happens to your cash? The answer is it goes up. Here we have a $3 million decrease in cash attributed to accounts payable. What happened to accounts payable? It went down from $4 million to $3 million. So when you have a liability that goes down by $1 million, you're paying off that debt. You're paying off that liability. When you pay your debts, what happens to your cash? It goes down. Same thing with accrued expenses, which is another liability. Here we have a $14 million decrease in cash attributed to fixed asset purchases. And so what happened to our fixed assets? The answer is that they went up. And so when we bought new fixed assets, that cost us cash. Now, if you issue new bonds, you're doing it in order to raise new capital, raise new cash. So we can see that this company went from $10,784,000 to $15 million. So it issued $4,216,000 worth of new long-term debt. That brought in that amount of cash. Same thing with common stock. We sold some new common stock. You can see that here and here, here and here. And we have a decrease in preferred stock, and this comes from the fact that we bought back some of our outstanding preferred stock, and that of course ate up some of our cash. And finally we have the dividends. When you pay a dividend, clearly you have cash flowing out of the firm. So here we have our net cash flow from operations, positive $9,184,000. There we have our cash flow from investments, negative $14 million. There we have our cash flow from financing activities, positive $5,816,000. That leaves us with a net change of $1 million, and our cash went from $9 million to $10 million. And so you can see that that $1 million positive change had all sorts of inflows and outflows behind it that netted out to that $1 million positive change. So the statement of cash flows gives us a lot of the details behind the screen. So that's your income statement, your balance sheet, and your statement of cash flows.